If you're selling options, cash-secured puts, covered calls, or spreads, understanding the Greeks is critical to managing risk and maximizing profit. In this video, I'm going to break down the 5 most important Greeks every option seller must know, and how they directly impact your trades. Let's go. Number 1. Delta, the probability and direction Greek. First up, Delta, the MVP for option sellers. Delta measures 2 things: how much your option's price will change with a $1 move in the underlying stock, and roughly the probability your option will expire in the money. So if you're selling a put with a 0.30 delta, there's about a 30% chance it gets assigned, and a 70% chance you keep the premium. Want safer bets? Go lower delta. Want more premium? Go higher delta, but take on more risk. Pro tip: for cash-secured puts, I usually target a delta between 0.15 and 0.30, depending on market conditions and my confidence in the trade. Number 2. Theta, time decay. Next is Theta, the time decay Greek. This is your best friend as an option seller. Theta tells you how much value your option will lose each day due to time passing. The higher the theta, the more your option premium decays daily, and that's money you keep. You want time decay to work in your favor. That's why many sellers focus on options 30 to 45 days out, where theta decay starts to accelerate. Pro tip: the closer you are to expiration, the faster theta works, but also the higher your gamma risk. Balance is key. Number 3. Vega, implied volatility risk. Third is Vega, which measures how sensitive your option is to changes in implied volatility, IV. When IV goes up, options premiums go up, great when you're selling. But if you sell in low IV environments and volatility spikes, your trade can turn red even if the stock hasn't moved. Pro tip: sell options when implied volatility is high relative to historical norms, then buy back as IV drops. That's called a volatility crush, and it's pure profit for sellers. Number 4. Gamma, the risk multiplier. Gamma gets less love, but for option sellers, especially close to expiration, it's a critical risk factor. Gamma measures how fast delta changes. Near expiration, gamma spikes, meaning delta becomes unstable, and your trade can go from winning to losing fast. This is why you want to manage or close trades before expiration week, unless you're comfortable with sudden, sharp P/L swings. Pushpin pro tip: if you've sold a 7-day option and the stock moves aggressively, gamma can flip your position quickly. Manage that risk. Number 5. Rho, interest rates. Kinda last and least for most retail traders. Rho, which measures how much an option's price changes with a 1% move in interest rates. Rho becomes more important for leaps or long-dated options. But for weekly or monthly selling strategies, it's usually negligible. Pro tip: unless you're trading options 6 to 12 months out, you can mostly ignore Rho. To recap, here's the quick checklist. Delta, choose your risk and probability. Theta, time decay works for you. Vega, watch volatility crush for profits. Gamma, avoid expiration week. Landmine. Rho only matters in long-dated options. If you want to become a more confident option seller, mastering the Greeks is essential. Drop a comment with your favorite Greek, or ask me about a recent trade you're managing. Like, subscribe, and hit the bell for more no-fluff options education.